We've all heard this story about the 2008 crash 100 times, and this is why we know that it had various market developments which were extremely harsh. For example, between 2007 and 2009, US households lost over $16 trillion in net worth, and this had an impact in absolutely every single aspect of the economy as we know it up to today. The market that felt the largest impact was the housing market. And between 2007 and 2009, there were approximately 7.1 million foreclosure filings. Just to put this into context, in 2024, last year, we only saw 300,000 foreclosure filings. And a foreclosure, for those of you that don't know, is when someone is not able to actually pay their mortgage, so the bank decides to just keep the house. So now you have a scenario where demand is at an all-time low and supply is at an all-time high. But there were people that emerged in these kind of circumstances, such as Marcos Fernandez, who decided to seize the opportunity. He was a 27-year-old, had a very good job, he was a tenant, and he had a very close relationship with his landlord. He started to see his landlord buy up foreclosures when the market actually collapsed, and he decided to shadow him. So at that time, he only had around $15,000 in savings, and he decided to get a loan, which was going against the market because everyone was trying to get out of debt and banks were almost collapsing. So in only 2 years, Marcus was able to buy 5 foreclosed homes for less than $60,000 each. Well, since he continued down this path, he became a serial real estate investor. And by 2025, he had built a portfolio of over 20 properties, which are worth more than $3 million today. So if we were to chart this opportunity Marcus actually seized, well, he went from buying one house which was worth around $52,000 to now his portfolio being worth over $3 million. Now, don't get me wrong, this isn't an appreciation only of the worth of one home, but this was because of all of the cash flow and the income that first house generated. He was able to reinvest it back, create more opportunities, and take out more mortgages. And that is how, nowadays, his portfolio is worth so much. This, over the past 15 years, has managed to accumulate to a CAGR of 17%, which is way higher than the standard 10% CAGR that we're used to see from the S&P 500. But I know what you're thinking. This case isn't realistic because, first of all, houses are not worth that little nowadays, and second of all, being able to buy 20 properties in 15 years just sounds completely unrealistic. Well, today we're not here to see if we can become multimillionaires only with real estate. We're here to see if real estate actually has a place in a long-term portfolio. But before that, we have to understand what exactly is real estate. So real estate involves the ownership or control of land and buildings for the combined purpose of capital appreciation and income generation. And there are various factors that influence the price of real estate. The first one and most important one being interest rates. Now, lower rates reduce borrowing costs, and this allows for increasing demand, which at the same time increases prices of real estate. Another factor could be economic conditions, consumer confidence, GDP growth, and just the general state of the economy affect the ability and willingness of people to invest or to just buy houses. Now, government policies and supply of real estate also have a huge impact. Measures such as tax incentives for buying houses, zoning laws, and even housing regulations can stimulate or even suppress market activity. And another example is just construction costs and inflation. Rising costs will increase property values, and this is especially true for new developments which are using more expensive materials, buying the more expensive land, and contracting more expensive labor. But now, who is really investing in real estate nowadays when practically everyone is renting? Well, I would argue that real estate is not actually closed off to anyone. You have retail investors, like normal people like me and you. You have professional investors, which are funds and indices where you can actually track. You have REITs, which are just companies that purchase real estate and generate income and give it out to all of its shareholders. And last but not least is the most interesting one, which is the other category. Countries such as Qatar, UAE, or even Saudi Arabia are some of the world's largest owners of real estate all around the world. For example, Qatar owns a very high percentage of the buildings in London. And now, if I had to give a rating to real estate as an investment, I would say that this can have a moderate return. It's relatively low risk, and this is especially true if you're considering a very long time frame. Now, if we were to compare real estate to stocks in a 5-year period, we could actually take as a proxy the S&P 500, which is the holy grail of stocks, and then we can take the all-rate index. And as we can see here, over a 5-year period, where the S&P 500 has almost returned at 100%, the all-rate index has only returned at 34%. But now if we were to zoom out 16 years, for example, we can see that real estate isn't so much of an underperformer. It has returned 480% over 16 years, while the S&P has returned over 600%, but considering that it is a way less volatile investment, it doesn't look that bad. And if you actually take a deeper look here, when is the point where real estate actually started to underperform? Well, it was around 2, 3, or 4 years ago where the Fed started to actually increase interest rates. And this was very bad for real estate, as the quote down below says. High borrowing costs have been a pain point for real estate investors. It's made deal financing more of a challenge and put pressure on asset values. And that is why it looks like real estate has actually underperformed the S&P 500 in these past 5 years. And now what was actually surprising for me was to see the risk and return comparison, because coming into this video we knew that real estate has a lower performance than the S&P 500 generally. However, what I was not expecting was for the all-rate portfolio to have a way higher volatility than the S&P 500, an 18% standard deviation compared to a 15%. But I actually looked into it, and this has a lot to do with how much the Fed has actually been moving interest rates in these past 3 to 4 years. So this just comes to show that real estate is extremely sensitive to macroeconomic factors that unfortunately are just out of everybody's reach. And again, as we did in our latest alternative investment analysis, we can see the performance of different investment vehicles considering 15-year returns. Now, the way you can actually get the most juice out of this investment is if you're a physical investor. This is if you're out in the market, you use your local knowledge in order to pick out the best houses, and then you take out the middleman, reduce the active management fees, and instead do it yourself. Well, this is the proxy when we compare it to all the other actively managed funds. Next, we have Prologis, and this is the largest real estate investment trust in the market. Well, this in 15 years has returned over 270%. Then you have the Dow Jones All Rate, which is the index that we have been tracking earlier in this presentation, which has returned at 250%. And then you have another company, which is Public Storage, another rate, but which focuses only on storage capacity, which has returned again 220%. But on the other hand, we have an index which just tracks real estate prices, which means that this is actually not considering reinvestment of the income generating. Well, this has only returned 80% in 15 years. So if you're a physical investor, you can actually manage your properties and unlock value through leverage, renovations, and again exploiting your local market knowledge, which are advantages that rates cannot actually exploit by design. And this is another quote by G. Brian Davis. But I know what you're thinking, because I thought the same thing. But real estate is only for the ultra wealthy. Where am I going to be able to find $300K or even more to buy a house and start my real estate investment journey? Well, nowadays you don't actually have to worry about that at all, because some beautiful thing called asset tokenization has actually emerged. And what this does is that it breaks down very expensive assets into different pieces so you can own a percentage of, for example, a house, a painting, a car. The way this works is by, for example, you have a house and you place this house into a holding entity like an LLC. You then create tokens for the ownership of this specific LLC, and then you decide to launch these tokens so that individuals can purchase these tokens. And then owners of those percentages can have some benefits and receive the income and capital gains that are based on their ownership. So at the end of the day, what you're doing is you're turning a house, for example, into a company. You're breaking its ownership apart and you're creating stocks, for example, which is then able to be traded publicly in the market. And there are a lot of platforms that are actually allowing you to do this. The most famous being State Guru, Lofty, Realty Mogul, Arrived, or even Fundrise. And now just to understand what has been sort of leading the prices of real estate over these past 20 or 30 years, we have a timeline of different market developments, starting from 2000 and 2006, where interest rates were extremely low and there were loosened lending standards, meaning that pretty much anyone could actually get a loan. Now we know exactly how this turned out, as from 2007 to 2009, we had the big crash with home prices falling by over 30% in the US and over 7 million foreclosure filings. Skip a couple of years forward from 2011 and 2013 is when institutions actually started to acquire single-family homes. And this was, we could call it, the creation of real estate as a proper investment class. From 2020 to 2021, the pandemic actually caused a house boom due to, first of all, very low rates, but again, the remote work introduction actually allowed people to understand that they needed houses which were bigger and which felt more like their own. And now, from 2022 to 2024, mortgage rates more than doubled, which actually cooled the demand and slowed the price growth for this real estate. And as with every single asset class, you have two sides of the stories that share success of real estate and stories that highlight setbacks. Some of the success headlines are a decade of home price growth in just 5 years with over 45% return for real estate, homeowners sit on record equity gains post-pandemic, $1 million home sales nearly doubled since 2020, and 2025 outlook, commercial real estate is poised for revival. On the other hand though, you have some articles such as US housing market sees worst year for sales since 1995, commercial real estate faces extraordinary era of unpredictability due to geopolitical tensions, construction slows as builders face tariffs and cost pressures, and office vacancy rates surge as return to work stalls. But now, who would I consider this investment to be right for? Because I think that real estate considerably has a medium potential return, a medium risk level, a very long time frame, a max drawdown which can be from medium to low, and it is able to generate income, with the accessibility being rated from low to medium considering that we now have those fractional real estate investment platforms. So I would say that this investment is probably right for investors which have a very long-term focus. But I do think that real estate can be a very good investment to add into your normal portfolio, as it can help you hedge against inflation, it provides some sort of diversification, as it has very low return correlation against bonds and stocks, and it has extremely predictable cash flow potential, as your tenant will have to live somewhere, so they will have to pay you on a monthly basis. And for potential investor characteristics, I see investors who can afford long-term liquidity, who are patient and are disciplined, and who have local market knowledge so they can exploit this real estate advantage. So I actually like real estate, and now that I've seen that fractional ownership platforms exist, I'm actually actively looking into them to add it to my portfolio as well, since I believe that this is an asset class that doesn't only shine at preserving purchasing power due to inflation, but it also offers you control and also diversification from other classical investments such as bonds, which I don't have a lot of trust in right now. Now, thank you for watching. If you stuck to the end of the video, you are a legend. Please let me know any other topics that you would want me to investigate and dive deeper into a video. And having said that, as always, thank you for watching. This has been the Cashflow Compounder. Join the free Patreon for extra content, and I will see you in the next one.